Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden in plain sight within corporate filings. And speaking of secrets, well, today we're diving into M3 Brigade acquisition. 6 Corp's latest filing, but this isn't just any filing, it's a pre-public offering document. A kind of financial baby picture for a company about to hit the big time. And let me tell you, it's got some interesting characters and even more interesting numbers. And before we dive in, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. You can join us there for more discussions and deconstructions like this. So grab your coffee because we've got a lot to unpack here. Alright, so M3 Brigade acquisition at Corp is a special kind of company called a blank check company. Think of it as a shell company with a pile of cash raised from investors, and the sole purpose of that cash is to go find another company to buy and merge with. Basically, it's a way for a private company to become publicly traded without going through the whole IPO thing and dance themselves. They've got about 30 million of these units to sell. Each unit is a package deal, a share of stock, and a fraction of a warrant, meaning a right to buy more stock later. The goal is to raise around $300 million before some fees, and the actual price per unit is $10. This filing is dated August 2025, and it's essentially their plan and prospectus for investors, detailing what they're all about. They are newly formed in June 2025, and so far they've done pretty much nothing in terms of operations. They've had minimal expenses and zero revenue, which is typical for this kind of setup. Now, they call themselves an emerging growth company and a smaller reporting company, which means they get to follow fewer rules and less stringent reporting requirements. It's like a fast pass for public companies, but it can make comparing them to other businesses a bit tricky. They've also elected not to use the extended transition period for new accounting standards, which is an interesting choice. Now, let's talk about the risks, because there are quite a few. They themselves point out that the nominal price paid by their sponsor for founder shares could lead to significant dilution for public shareholders. Remember those 8.6 million founder shares? Well, they were bought for a mere $2,000. That's a tiny fraction of a penny per share. This means the people running the show can make a substantial profit even if the company's stock price drops after a business combination. It's a setup that truly incentivizes the sponsor to get a deal done. Also, they openly admit that the value of these founder shares following a business combination is likely to be much higher than the price paid, even if the stock price is way down from the initial offering price. This is a big red flag in my book. It means the insiders could profit handsomely while public investors might still be nursing losses. They also highlight that their management team members might be juggling responsibilities with other businesses, creating potential conflicts of interest that could negatively impact their focus on this venture. Let's look at some numbers in the dilution table. If we imagine a scenario where nobody redeems their shares and the underwriters don't buy any extra shares, the net tangible book value before the offering is basically zero or so close to it you can't see it. After the offering, even if nobody redeems their shares, the pro forma net tangible book value basis due to the share structure and fees. Out of the $300 million from the offering, only about $280.5 million comes to the company after underwriting discounts and commissions. Then there are other expenses like legal, printing, and accounting, totaling around $85,000. This leaves roughly $280 million in the trust account for the actual business combination. Looking at their balance sheet as of June 10, 2025, it's pretty basic. Total assets are just $633,333, and most of that is just prepaid and deferred offering costs. Liabilities are around $506,000, leaving a shareholder's equity of a mere $702. This is pre-offering, obviously, meaning they have almost no resources before the public gets involved. The as adjusted numbers show what it would look like after the offering with about $31 million in assets, but there's also a substantial chunk of deferred underwriting commissions leading to a negative shareholder equity in that adjusted column. The auditors, Witham Smith Bless Brown, PC, have issued a crucial statement here. They've highlighted a substantial doubt about the company's ability to continue as a going concern. This is because M3 Brigade Acquisition Corp doesn't have enough cash and working capital to keep going, and their whole plan hinges on this public offering succeeding. It's standard language for companies like this, but it still underscores the high risk, high reward nature of these investments. They're also worried about how things like pandemics, global conflicts, and economic downturns could really mess up their plans to find and buy another company. Global instability and rising inflation are some of the external threats that could make finding the right deal and closing it much harder or even impossible. A really important point is that their sponsor, as well as officers and directors, have agreed to waive their right to get their money back if a business combination doesn't happen. They're essentially tied to the success of the venture, whereas public shareholders can redeem their shares if they don't like the deal. This aligns the insiders' interests heavily with getting a deal done no matter what. Scroll, what's my take? Well, this is a classic SPAC play. The leadership team has experience with previous SPACs, some successful, some not so much. The strategy of targeting disruptive growth sectors, especially crypto and blockchain, is ambitious and could pay off big if they pick the right company. However, the dilution from the founder shares and warrants, the early negative tangible book value, and the auditor's going concern warning mean this is a very high-risk investment. The sponsor is clearly incentivized to make a deal happen, and that could lead to them pursuing less than ideal targets to avoid losing their own investment. Public shareholders have redemption rights which somewhat shares and warrants the early negative tangible book value, and the auditors going concerned, the sponsor is clearly incentivized to consider. It's a speculative play designed for those who believe in the management team's ability to execute a successful acquisition in a potentially volatile sector.